3 easy steps to identifying key trading levels of support and resistance. In this video, we are going to cover the basics of how to properly draw key trading levels of support and resistance, as well as how to trade off those levels using your own moving average pullback strategy. There's no doubt that you've heard of support and resistance. What you may not know is that plotting every single level of support and resistance will litter your charts with false trading signals, which ultimately cost you money. Key trading levels will clear out 75% of those false signals, cleaning your charts and providing you with the most actionable trading levels that you are most likely to profit from. Typically, support and resistance will be drawn on the current time frame in which you are trading. The problem with this is that all of the support and resistance, no matter how insignificant, is visible when plotted in this way. The way that we remove the clutter, eliminate the false signals, and reduce the probability of being stopped out is through plotting key trading levels instead of standard support and resistance. Key trading levels are levels of support and resistance which are found on the larger time frames like the daily or sometimes even the weekly charts. The longer the time frame, the fewer key levels will be visible, which will ultimately result in fewer false signals. As a rule of thumb, we typically go at least 2 time frames longer than that of which we are currently trading. If we are trading the 1 hour, we might use the daily for our key levels. If trading the 5-minute, we might use the 1 hour for our key levels. Key trading levels are levels of support and resistance which hold more significance, more strength, and more reliability than regular levels of support and resistance that are normally found inside the time frame which you are currently trading. While support and resistance can be drawn on any time frame, taking trades off of only the key trading levels from the longer time frame charts will prove to be significantly more reliable than drawing support and resistance on the current time frame that you are trading. Once we have zoomed out into a longer time frame like the daily, we look for multiple points of contact at a price level in which you can clearly identify multiple reactions. Key trading levels will often have provided both support and resistance at some point in time as price retraces to that level from both beneath the level as well as from above. Reactions and retests of these levels should be obvious as price bounces off of or retests these levels, usually forming either reversal patterns or reversal candlesticks once price has touched these levels. More often than not, especially on the longer time frames, you will see reversal candlesticks or patterns like dojis, double tops, and head and shoulder patterns, which provides clear opportunities for taking trades as price is giving you the reaction needed to confirm that this level is relevant and that traders are reacting and trading off of it. Here, we are looking for a trade entry off of the 5-minute chart. As you can see, plotting support and resistance at this point would give us an overload of trading levels, most of which would be unreliable in terms of entering a trade. Even more important is the fact that there is little to no room to trade between these levels. Now, when looking at the same 5-minute chart, if we were to zoom out to the daily chart, notice how much less noise there is when looking for the visible support and resistance at this point. We can still clearly see where price is reacting to multiple points of interest, both from above and below. The goal here is to plot levels as accurately as possible without placing levels too close together. Remember that if you miss a level or don't plot it, there is no consequence as you will simply miss the trade. However, if you place a level that isn't actually there, then eventually you will take a trade off of it, which will most likely result in a losing trade. So, while you might think that placing more levels will give you more trades, the reality is that plotting fewer levels will give you more profitable trades. Go through the daily chart and plot all of the clear and obvious levels of support and resistance which contain multiple reactions, just as you would with standard support and resistance. Remember, less is more. Once we have those daily key levels plotted, now we can zoom back into the 5-minute chart that we were originally looking to trade from. Notice how well respected these levels are, creating reliable trading zones instead of unreliable noise, confusion, and false trading signals. Notice the space between these levels is now more available to trade between, and we can use these levels for both reliable entry points and profit targets. Beginning on the 5-minute chart, we zoom out to the daily. We plot our key levels. Then, we zoom back into the 5-minute chart to look for trade entries. Leave these levels on all of your charts and time frames. Once plotted, these levels should be respected on every time frame and all trade setups. If you haven't already, feel free to watch our moving average trading strategy video, which shows in detail how we pair these key levels to our own singular moving average to create high probability trade setups. All of the links will be below in the description. Please don't forget to like and subscribe if you learned something new. Also, don't forget to save this video in your trading folder so that you can revisit us in the future. An occasional refresher on this material will only help to solidify these concepts further. I wish you the best of luck in your trading. Always remember to trade safe, trade smart, and trade profitably. Thanks for watching, and happy trading.